Hello and welcome to the Retirement Planning Podcast, your trusted source for navigating the path to a secure retirement. Your host and guide on this journey towards financial peace of mind is Darrin McComas. On this show, we'll delve into everything you need to know about retirement planning, from investment strategies and risk management to maximizing your Social Security benefits and crafting a resilient financial plan using the bucket plan financial process. Join me as we bring you insights from top financial experts, share stories of successful retirement journeys, and provide practical tips to help you build and preserve your wealth. Let's embark on this adventure together as we strive towards a future where retirement isn't just a dream, but a well-planned reality.
All right, welcome to another episode of the Retirement Planning Podcast. I'm Darrin McComas.
And I'm Jason Fox.
Well, thank you for joining us today. We're going to do a deeper dive. We did an episode earlier on the One Big Beautiful Bill, but I think we're going to try to do 4 or 5 shorter episodes and do a deeper dive on the specific things you could take advantage of, especially heading into retirement. Today, we're going to focus part 1 here on Roth conversion strategies. So I think it's so important heading into retirement that you kind of shift your mindset right out of that accumulation mode into more of what does retirement look like when we don't have that paycheck coming in anymore. We know we're going to have required minimum distributions sometime in our 70s if we have pre-tax money.
And then the name of the game becomes preservation versus accumulation, right?
Yeah. At least with part of the, your life savings. But this is such an important concept, especially if you want to do Roth conversions, get more tax efficient in retirement. It's this concept, these 7 little words that are so powerful, and that's not all money is taxed the same. And what do we mean by that? Not all money is taxed the same. And it comes down to these, really, there's 3 different tax funnels, tax efficient funnels. When it comes to taking income in retirement, you're either going to be pulling out of one of these 3 funnels, 2 of these 3 funnels, or if you're fortunate enough, all 3. And you can often blend your sources of income and really manage your tax efficiency and have a lot of control. So let's go through them real quick.
Yeah, sure. Go ahead.
The pre-tax funnel, Jason is right. You put in those contributions while you're working, you get the employer match. So we're talking things like IRAs, 401ks, 403bs, 457bs, and pensions, right? Tax deferred while you're contributing. Well, in retirement, right, we're not contributing anymore. We're taking distribution.
Yeah, that IRA is not actually an individual IRA, right? You are partnered with the government. They've allowed that account to grow tax deferred for the entirety of your career. And now they want their piece of the pie.
That's exactly right. And distributions from this funnel, they're taxed as ordinary income at both the state and federal level. So keep that in mind, especially if you're a ways off from retirement. Do you want to have all your life savings jammed into that funnel? And then, like Jason said, you're married to the IRS. You're married to Uncle Sam. That middle funnel, the tax advantage funnel, this is where you make contributions with pre or after tax dollars,
right?
You're looking at like Roth IRAs, health savings plans, 529s, cash value life insurance. So you're funding this with really after tax dollars, and all the growth is tax free. When you pull the money out, distributions, for the most part, are tax free from this account, and it's a very powerful account, especially the Roth IRAs, cash value life insurance to have in retirement. And we're going to go into some specific examples later where you're doing some Roth conversions and what that can do to your tax bill in retirement. And then kind of, Jason, walk us through this middle funnel, the post-tax.
And then we have the post-tax, which is your brokerage accounts, your bank accounts, real estate. And this is when you're getting taxed on the gains that you have. For example, if you buy a house at, say, $500,000, and then you sell it for, $1.5 million later on, you're going to be taxed on a portion of those capital gains, on that extra $1 million that you made. There are some caveats there and some nuances there in terms of how much you get taxed. But in general, you're going to have, either 0,
15,
and then 20% capital gains tax depending on what your income levels are and that sort of thing.
Yeah, and that's for long-term capital
Yes,
gains.
correct. Yes.
Assets that you've held for more than 12 months and you sell them, they've appreciated, you're paying taxes on just the gains.
Yes.
And if you can keep your income low enough, right, you can take advantage of those, those first two, the 0% capital gains and 15%. And usually those, even the 20, quite often with our clients, those are more favorable than their normal federal income tax rates, which quite often are at 22 or 24 or 32.
Absolutely.
And what you have to think about, right? We just got this one big, beautiful bill passed. In our history, what we often see is when we have tax deductions or tax reductions in legislation, that pendulum eventually will swing the other way and taxes tend to go up.
Yeah.
So, if you're in that pre-tax funnel, you're definitely affected by what is the policy at that time. And we always say this, right? And we've said it before on this podcast, tax laws are written in pencil.
Right.
They may say permanent, but really it's permanent until the next
administration comes in, right?
Or next Congress comes in. Yeah.
Right. And so right now we've got a great opportunity because we're in historically low tax brackets and tax codes. And so that's a great opportunity for our clients, right? To utilize these kind of strategies that we're discussing today.
Yeah. And it really comes down to this. I don't think anyone out there listening doesn't want to keep more of their money, right?
Yes.
No one wants to leave the IRS a big tip when they don't have to. And often when we see people leaving the IRS a big tip, it's because they're not being proactive. They're not zooming out over their lifetime tax burden, and they're just looking at a very narrow window of time, this year, next year. And they're trying to minimize their taxes, but they're missing the big picture, right? They're not seeing forest through the trees.
Absolutely. And that's what we typically see with CPAs, right? They are doing an autopsy, over the past year. What was your situation like? What can we do to minimize your taxes for this year? And while that can be useful and it's a great tool at times, we really try to avoid that. And like Darrin's saying, zoom out, take a look at your entire situation, your entire lifetime tax burden, and then optimize that situation.
Yeah, because I think this is grossly estimated by people. But, when you ask them what's going to be one of your biggest expenses in retirement, they often say healthcare or housing or vacations. But honestly, for a lot of people out there, it's taxes. Taxes are going to be one of your top 3 biggest expenses. And when we show those projections in our financial planning software to people of what the next 25 or 30 years of their life looks like for their tax burden, their eyes usually get real wide and they're shocked by that huge number. And it's, again, coming down, what can you do to be proactive, take advantage of these currently low historic tax rates we're in, and look for ways you can optimize your taxes. So when you retire, you can leave behind many things, right? You can leave behind the daily grind of working that 9-to-5 job, the commute, right? Maybe you sell your old home and you downsize or move to a new location that you've always wanted to live because you're empty nesters now. But the one thing you're going to keep is that tax bill.
Death and taxes, right?
Yes. And even when you die, sometimes those taxes get passed on to your heirs. So again, hear us loud and clear. We're saying taxes are going to be something you want to definitely take a proactive approach to. And even if the laws don't change in the future, and these historically low codes stay in for the next 20, 30 years, oftentimes you're not triggering a tax increase. It still pencils out to look at some of these strategies. Again, we said it, taxes can be one of your largest expenses in retirement. And a lot of that has to do with required minimum distributions. Also, just longevity. Us guys, we typically don't live as long. And if we're married, our wives tend to outlive us. And you can put them in we call it the widow tax trap, right? Where you lose that opportunity to file a joint tax return where the tax brackets are really twice as wide. The poor surviving widow
shrinks, right?
Yep. Those tax brackets get cut in half as a single filer. But guess what doesn't get cut in half? Those required minimum distributions. Those stick around and get passed on. and can really wreak havoc to the surviving spouse. So again, when you're thinking about retirement, yes, investments are super important. Having a plan is super important, but you've got to look at taxes if you really want to optimize your retirement and keep more of your money.
Absolutely. And I think it's a fundamental shift for a lot of people because we're kind of used to, planning maybe a year or 2 years at a time. But what we're talking about here is you're looking, 20, 30 years into the future to take care of that surviving spouse. That requires being proactive, right? That requires having a plan that's going to understand the dynamics of that time that's passing on, right?
Yeah, and the numbers, the numbers don't lie. The historical averages just say women definitely live longer than us guys. So
well, absolutely,
most men out there want to protect their spouse. Even when we're gone, we want to leave them in a good position. And taxes, they're not, are taxes intuitive? I would say no, they're not intuitive. It's really kind of fuzzy math. Sometimes what's on this side of the equation doesn't equal what's on this side of the equation. So here's a great example of how they're not intuitive. So we look at how can $10,000 of income, additional income, increase your taxable income by 18,500. So
wait a second, Darrin, that doesn't make any sense.
Yeah.
Walk us through that.
So yeah, let's look at this. So let's pretend we have a married couple filing a joint return. They're both over 65. They get a combined Social Security benefit of $46,000. They have RMDs of $23,000. So they have a combined total income of $69,000 for their household.
Right.
They go to file their taxes. They have no taxable income.
Seems pretty good.
Right. They don't owe anything. Now, take the same couple, same Social Security benefit, $46,000, same RMD, but now they, decided to remodel the kitchen and they pulled out $10,000 out of their IRA on top of those RMDs. So we have an additional $10,000. So now we're saying $79,000 of total income versus $69,000. That additional $10,000 you would think might trigger $10,000 worth of additional taxes, but actually now we're looking at a taxable income of $18,500,
which seems like backwards math, right?
Right. And this triggers a tax bill that's $1,853. So massive difference, right? Of just a small income adjustment, right? And you don't see the repercussions of that move.
Right. Yeah. And as you're about to explain, I'm sure that's has to do with those Social Security benefits, right? And those thresholds that exist with Social Security.
Yeah. And now part of your Social Security gets taxed and, and boom, that's when that taxable income jumps. So for every move you make, in retirement, right? You got to weigh the pros and cons, and you got to see all the ripple effects of taking income, especially when you're taking it from that pre-tax funnel. So we really preach understanding your tax brackets. And I love this graphic. It shows on the right-hand side, the different tax brackets and the break points for married filing a joint return. And the standard deduction this year is going to be $30,000. If you're over 65, right, you get that extra deductions. On the left-hand side is a single filer. And then underneath this measuring cup are the capital gains tax rates, where you can either be in that 0, 15, or 20% capital gains taxes. So knowing where you're at, what bracket you're in is super important. And then how much room do you have left in that bracket where you could be proactive and maybe look at a Roth conversion. So here's a real example. All right, a married couple, they're in that 12% bracket, filing a joint return. They have $96,950 of taxable income. Their current gross income is 60. Their standard deduction is 31,500. They have current taxable income of 28,500, right? Do the math, subtract the 60 and the 31,500. And if you look where that puts them in that 12% bracket, they have a conversion capacity. They still have about $68,450 to play around in that 12% bracket.
Sounds like a great opportunity to me.
There's a great opportunity to do some conversions and not jump to that next bracket, which is 10% higher, which is 22%. So,
and it's important not just for the taxes on that money, which is of course part of the equation, but we're also looking at the Medicare and the Social Security and how the ripple effects of affects that as well, whether you're talking about premiums or how you're taxed, right?
Right, exactly. And why does this matter? Why do we care about doing Roth conversions, right? Why do we preach being proactive? Well, from a historical perspective, the 12% rate may never be this low again.
Yeah.
We may never see this opportunity in the next 20, 30 years.
Yeah.
You're talking what, 36, 37 trillion in national debt,
And growing
inflation,
rapidly every day.
Medicare is getting more expensive. Social Security is a real mess. Like, we may never see these rates again.
Yeah.
So take advantage of them. Obviously, do the math. Talk to a professional, right?
Yes.
And see if these conversions make sense for you. Why else would it matter? Future tax risk. Like I said earlier in this episode, rates go down. They're typically followed in our country by a rate hike.
Sure.
So some people like to say taxes are on sale. That's a good way to think about it right now.
Yeah, absolutely. Plus, you get that tax-free growth, right? The sooner you get that money into your Roth, the longer it has to grow. That means it has longer to recoup the taxes that you did pay on it, as well as time to grow and then utilize later in life. Because a Roth IRA dollar is worth more than a traditional IRA dollar, right?
Yeah. How many times do people come in, they show us their statement and, using round numbers, hey, I have $1 million in my IRA.
Right.
I'm good, right? And you're like, you don't have $1 million. There's probably, take 20 to 30% off of that for taxes. So, again, would you rather have that growth in the IRA or in the Roth? And personally, the Roth is hands down where you want that compounding growth to occur.
Far more powerful.
There are no RMDs on Roth IRA funds, so that's a huge advantage. If you don't like the government forcing you and telling you what you have to do, the Roth IRA is kind of off limits. And if you don't want that money, don't need that money, you can let it stay invested in the Roth, where you don't have to be forced to take that required minimum distribution.
Yeah.
We're talking for the original owner of that Roth, obviously. It can lower your Medicare premiums, right?
Yeah. Not considered part of the equation for what your Medicare premiums look at, right? So with your traditional IRA, whatever you pull out is going to be considered within your IRMA calculation, but the Roth is not.
Right. And no one likes to be married to Uncle Sam, and I tell you, Aunt Irma is no fun either. And if you don't do anything about this and you have a substantial amount in pre-tax money, and then those RMDs kick in, it can easily bump you a Medicare bracket or two. And if you're married, it's going to affect your spouse's Medicare premiums as well. And that could be a nasty surprise. So again, looking down the road, what's coming on the horizon.
Absolutely. And of course, we've already talked about it a little bit, but protecting your spouse is a huge part of the Roth strategy, right? We want to avoid the widow tax trap. We want to make sure that our spouse is well taken care of, for the entirety of their life.
Absolutely. And losing that capability to file a joint return.
Yeah, it's a big deal.
It's very punitive to the widow. So do what you can now to protect your spouse. And then estate planning advantages, right? The beneficiary can continue to defer that Roth for 10 years. When you inherit a Roth, thanks to Secure Act and Secure Act 2.0,
right?
If you inherit a Roth from your spouse, you have 10 years to take all the money out. Now, you can let that money stay in there and grow and compound, and then take it all out that 10th year, but it comes out tax-free.
Yeah, absolutely.
Same as your beneficiaries.
It's a huge deal because, again, traditional IRA, if that passes on to your beneficiaries, whether it's your spouse or your kids or whoever, they've got 10 years to take that out, but it's going to count towards their income, right? And that can just blow up the tax profile of whoever it is that you were hoping to benefit.
And then you lose a big part of that legacy. Goes right back to the IRS when it didn't have to. So let's do another example. Here's an example. We call it a Roth conversion acceleration. So it's kind of a sprint here. Besides just bracket bumping or bracket topping conversions, which we just showed you that example, maybe you want to consider a more aggressive approach. So here's a 5-year Roth conversion sprint. You have a couple married filing a joint return. They have a $2 million IRA. Their current taxable income is of $100,000. We're going to use nice round numbers here. The strategy is they want to convert 400,000 of that $2 million IRA annually and do it over 5 years. The tax cost to do that would be approximately $88,000 per year if they're in that 22% tax bracket. The result is they get 2 million growing tax-free forever. And last I checked, forever is a long time in that Roth IRA. And here's the big benefit, right? Is tax-free inheritance to their beneficiaries. And versus possibly as high as a 37% tax rate if the kids inherit a traditional IRA.
Yeah, absolutely. And it's a huge difference maker for those who are in a position to pass something on to their beneficiaries, whether you're talking a surviving spouse or the kids.
Yeah.
And what a difference to not have to worry about the tax burden and just be able to enjoy that money for whatever it is that they're using it for.
Yeah. And if it doesn't go to the kids, like here's another doing this kind of strategy, you would have 2 million of Roth money to use for maybe long-term care protection. Heaven forbid one of you ends up in a facility for a couple years and you're spending 20 grand a month. Is it better to be trying to fund that 20 grand a month out of your IRA where you're going to get crushed in taxes, or out of a Roth where it's all tax-free, to get the help you need?
Yeah.
And when a life event like that happens, you don't have a choice. You're going to want to protect your spouse and get them the best care they have. And again, it comes down to being forced to take it out of a taxable account like the IRA or a tax-free like the Roth.
Yeah. And I would say at the end of the day, to your point, it gives you options, right? And that's what this is all about. What this planning is about is to give you options down the road, to not be pushed into a corner where you can no longer choose how it is that you're spending your money.
Yeah. And no one I think everyone we talk to wants to have control, right? We want to control as much as we can in our lives and in our work, and to not have any control when it comes to how you're taxed later on is not a great feeling.
No.
You're just at the mercy of the IRS and the tax codes, and those are constantly changing, and it just adds more stress to retirement.
Yeah.
All right, we're going to wrap up today's episode with just another example. Well, doing Roth conversions is a powerful tool. We're huge believers in having Roth IRA money. But another great option too, you might want to consider is, draining that IRA account and using that money for life insurance. So let's go through an example here. For healthy clients, life insurance can provide a superior wealth transfer versus an IRA. Again, let's look at an example. We have a $1 million IRA. They have systematic withdrawals over 10 years. So probably funding a life insurance product here, we call it a 10 pay, right? You pay a premium for 10 years and then you have that policy funded. So we're taking this $1 million IRA, we're going to take out $100,000 each year over 10 years. We're going to fund a life insurance policy with it, a permanent life insurance policy. So the after-tax amount that we get to fund that policy with, after we siphon off those 22% taxes, $78,000 per year go to fund that policy.
Right.
With that $780,000 of total premiums, you've just now purchased around a $3 million permanent life insurance policy.
So you turn that $780,000 into $3 million.
Right. Of tax-free money, right?
That
death benefit that is paid out upon your death, whether it's to your wife or to the kids, or if some of that money goes to pay for your estate taxes and pay off their mortgage, right? That money is all tax-free, and that's a huge net advantage. And that could be two or more plus $1 million more to the heirs.
Right. Absolutely. And some people, when they hear this, they're like, well, what if I need that money? Right. Well, you can borrow against that as well, right? It's not just
cash value there.
It's not just locked up forever until the day you die.
Mm-hmm.
You have access to that money and the ability to use it as you need it.
Yeah, and it's a very powerful estate planning tool, right?
Absolutely.
As well, if you do have a long-term care event, life insurance money is
Yeah.
something that's not subject to the spend down rules. So
Right.
great tool there to protect your loved one, as well as pass on some great benefits to your beneficiaries,
Yeah.
tax free. So I hope you enjoyed, these examples, these Roth conversion and using life insurance as an IRA replacement. So we're going to continue doing a deeper dive on more of the One Big Beautiful Bill in our coming episodes, but you can check us out, Jason and Darrin at Evergreen Wealth Advisors. We're on Instagram, LinkedIn, Facebook, Twitter, and you could subscribe to our YouTube channel, right? It's the Retirement Planning Podcast. So thanks again for watching. I hope you learned some more. If you're interested in some of these strategies we brought up and you're trying to do this yourself, or your advisor is not being proactive in bringing these to you, we'd love to talk with you. So find us online, ewadvisors.com.
Jump on. We'll do a free consultation. Give you a chance to have some of your questions answered.
That's right. All right. Well, thanks again for joining us on the Retirement Planning Podcast, and we'll see you next time.
See you later.
Thank you for listening to the Retirement Planning Podcast. We hope we inspired you to make changes so you can live your best life. If you want to find out more about what we do, or you want to have a holistic wealth and health financial plan, please visit our website. Please subscribe to the podcast and share it widely with your friends and family. Financial planning and advisory services are offered through Prosperity Capital Advisors. PCA is an SEC-registered investment advisor with its principal place of business in the state of Ohio. Evergreen Wealth Advisors and PCA are separate non-affiliated entities. PCA does not provide tax or legal advice. Insurance offered through Evergreen Wealth Advisors are not affiliated with PCA. Information received from this podcast should not be viewed as individual investment advice. Product discussions and illustrations are hypothetical in nature and will vary based on many factors, including but not limited to age, health, product, insurance carrier, and product design. You should consult the insurance carrier website and policy for detailed information pertaining to the registration status of PCA. Please contact the firm or refer to the Investment Advisor Public Discourse website disclosure statement as set forth on Form ADV from PCA using the contact information herein. Please read the discourse statement carefully before you invest or send money.